Hello and welcome to the Fintech Finance Virtual Arena. Joining me on today's session is Brash from PPS and Ben Regnard-Weinrabe from Allen Overy. Today we are going to be talking and discussing about all the huge changes in regulation and ultimately compliance that are dramatically shifting the way that businesses and payment companies can operate in the future. So guys, thank you so much for joining me here today. To kind of kick the session off, I wonder if I could get you guys to introduce yourselves a bit more. So if I could start with you, Ray, could you tell us a bit more about yourself and PPS, please?
Yeah, hi Doug. So I'm Ray Brash. I'm the CEO, chairman, one of the co-founders of PPS. We are a payments banking as a service provider. Been going since 2003. So we've seen quite a lot of developments over those last 17, 18 years. And I guess we're quite unique in the market in that we provide a genuine end-to-end. So whilst we're a technology company at our core, and that's quite often what we talk about, we're also regulated business both in the UK and in the EU in Brussels. So regulation, compliance, and e-money goes hand in hand with what we do. So I think it's a really, really good topic today to talk to.
Well, thank you very much. Yeah, it's the perfect intersection of everything we're going to be discussing. And also, Ben, could we also get your introduction, please, and a bit more about Allen Overy, please?
Absolutely. Well, great to be here today. Thank you so much for having me. So I co-lead the Fintech team at Allen Overy in London, and also I lead the payments team. Very privileged to work with a bunch of very enthusiastic people. And we advise on payments regulation and broader regulation and projects and all sorts of things for a range of different players, such as fintechs, big techs, digital banking arms of big international banks, and so on and so forth. So a lot of fun, very international work, because fintech, of course, is global.
Yeah, it really has shifted with numerous external factors, but it's really hit its stride in that regard. Now, with that in mind then, Ray, if I could come to you first to kick things off. With the huge amount of payments innovation that we've seen around the world, as Ben mentioned, regulation has also followed suit. So, I mean, to you, what have been some of the biggest regulatory changes in the payments industry specifically within the last 2 to 3 years that you think have had the most lasting effect?
Well, a massive amount, obviously, which is why Ben is probably on a higher pay grade than I am with all of his advice. But the way I would look at it, I wouldn't necessarily list all the regulation. We haven't got enough time for that. But I'd look in terms of the frameworks and what are the overarching principles here. And I think it's interesting because you've got some conflicts. Obviously, regulation is imposed primarily by the authorities and governments, but also, schemes and participants in payments ecosystems. But you've effectively got two kind of conflicting directions. So, and the EU, we've seen more regulation than anywhere else in the world when it comes to payments. So, whilst we were in the EU and even now, UK fintechs have been subject to this type of thing, as I said, since 2004 when we launched. So you have primarily the EU with an agenda to open up competition in payments. But that's been a theme for 10 years. And it's been partly through regulation, through things like the Payment Service Directive, which was to try and level up the level of permissions that are required for payment entities, and also broaden the definition and allow, payment institutions, e-money institutions to come in and sort of participate in the financial services space. So that kind of opened up the market. And since then, we've seen very headline initiatives like open banking initiatives, which is even going further. And that allowed a lot of entrants to come in. But then on the other hand, you've got the protection of the consumer. So the regulators want the consumer to have choice, but they also want them to be protected, which kind of goes against the first one, because when you see protection on the consumer, typically it's either to protect them from being victims of financial crime, clearly a hugely important topic. However, the regulators sometimes are not in the best place to do that because they're looking at a particular, very, very sort of strict view. They don't necessarily understand how consumers use payments. And also, the other area might be in things like lending, where, again, for probably the right reasons, regulators would always be concerned about affordability and individuals getting the right financial service that they think. Those two things kind of stop innovation to some extent, and the former allows it. So you've got this kind of 2 steps forward, 1 step back approach. And then the last bit, which is probably more pertinent in the last 18 months, is generally the sort of the new entrants and their financial and liquidity and stability, how funds are protected. So you have new entrants, you have consumer protection, and then you have the overall regulation of those entrants. So if you look at those 3 things, in my mind anyway, and you can hang loads of regulation around it, but in short, there's just more of it.
Yeah. And I think that's a really interesting point to bring up. It's just this wealth of regulation amongst this huge amount of innovation, causing just the industry to be changed in ways that we probably hadn't once seen. So, Ben, I'd also be interested in your perspective on this as well. Do you agree with Ray that we're making 2 steps forward when it comes to innovation, and then maybe 1 back with the regulation to kind of not stifle innovation, but make it measured?
Regulation can be seen, I guess, as the brakes on innovation. But at the same time, I think the industry can welcome regulation where it is proportionate, where it is about ensuring that there is a leveling of the playing field, that there is additional access and opportunity. And a lot of payments regulation over recent years has had a competition theme to it. And Ray gave the example of open banking. But also, if you think back to the creation of the payment systems regulator, which became operational, I think, back in 2014, you'll see that these and other areas of regulation have been actually trying to give a bit of a lift to fintechs coming in, challenging incumbents. Now, the other thing to note is that regulators, particularly in the UK, have tended to be lighter touch in terms of how they supervise fintechs, smaller firms who are emerging. And it's also worth noting that when it comes to payments, actually the regulation of payments, although detailed, has been relatively manageable for payments firms, in particular fintechs, to cope with, because you see that payments firms have been very successful in internationalizing their model, in launching, expanding, internationalizing. Ray touched on credit, and credit is a tougher proposition that tends to be much more diverse in terms of how it's regulated across different jurisdictions, more heavily regulated, often more heavily policed, and therefore harder to launch and internationalize a credit product. I think there's certainly a perception that sometimes regulators may get it wrong, sometimes regulation may go too far, sometimes regulation may depend too much upon information provision, and arguably that's over the top because consumers don't necessarily read the regulation, the information that they're provided with. So, it could probably be improved in areas, but I think on the whole, there tend to be some clear objectives, which are such as competition, such as consumer protection, which regulators pursue. There also, of course, in recent years, have been much more focused on security. Now, you could argue that maybe they've gone over the top, maybe they've not made enough exceptions, but again, they did it for specific policy reasons. And I think some people will have welcomed it and other people less so. So I think with regulation, it's always going to have an impact in different ways on different models, different ways of doing business. But on the whole, I think to give credit to the European regulators, they have created a framework for particularly around payments regulation, which has been copied across the world in many other jurisdictions. So it can't be all bad.
No, I think that's a really good point. And Ray, if I could come back to you, you mentioned it in your answer as well, actually. One of the third tranches that you've seen is kind of regulating the new kids on the block effectively. And I'd like to ask it, because obviously Ben brought up the security aspect. but also we've got to talk about the compliance aspect within that. How can fintechs balance their innovation, their commitment to innovation that they're known for and world famous for, whilst also maintaining these new streams of, for instance, security regulations, or just in general, compliant with other payment regulations?
Well, I mean, fintechs are not kind of from a different planet, yeah? It's a name for companies, and it's about the application of technology in financial services. And, I did a presentation last year, I think. You can go back to the early days of guys like Capital One or even Barclaycard, ATMs. I mean, it's all technology moving payments forward. So it's not a new thing. And that's what it is. It's about taking, a smart idea and seeing how you can apply it in a financial services world. Now, clearly regulation is an important part of that sort of dimension, but regulation applies to everything. You're going to make a new orange juice, or, you want to do some advertising. There's always regulation. I mean, payments is no different from that. So clearly the customers that we work with, they very much understand the need for regulation. Some of them are actually regulated themselves. Whilst we're an e-money institution, some of our clients are also small e-money institutions, which was, again, as Ben pointed out, a way the EU has allowed small entrants to come in. So there's there's a lot of mutuality between the two. And the way fintechs, I think, apply it is kind of that they see it as a massive opportunity, as we did back in the day, where we realized that as an e-money institution, we could go places that traditional banks and payment institutions couldn't go. We could actually generate business by certainly adopting the regulation, understanding it. We also built a lot of our processes and a lot of our products around the new regulation. Ben and I, we were just talking before the screening here, and we talked about in the early days of things like the money laundering directive, which was sort of allowing products to be like KYC. Well, we created technology that allowed those things to happen. And so the fintechs have the opportunity to challenge what I would call as compliance debt. In coding, you've got something called technical debt, which is legacy. I think banks have compliance debt. Legacy processes around regulation that have been so embedded into their organization, their systems, they find it very, very difficult to adapt to new regulation. So, the regulation tries to keep up with technology, what you're finding is the traditional banks, they're getting a bit left behind, because they haven't got the ability to adapt. Most of the fintechs that we work with, when there's a change in regulation, let's say it's changing like the contactless limits through the COVID, or one-time passwords for strong customer authentication, data analytics screening, they're on it. They can do it, they can react, and they can be very, very, credible in that space. And they also look at the principles I said earlier on about, they're a new entrant. If you look at trust, which is a huge part of financial services, fintechs have absolutely embraced the need to be open and transparent with their customers about fees, about, if there have been operational issues, about experiences. If you look at the sort of the chat rooms of these fintechs, you'll find very, very open discussions about why my service hasn't worked. So trust, I think, is fundamentally part of the consumer regulation. They bring that for sure. As I said, data, fraud analytics, being real time, and also in terms of adapting, they partner as well. So the other thing that I think makes fintechs more adaptable to regulation is, they don't have to control everything. Traditional retail bank will say, well, I've got to have everything embedded. I'm going to control the whole compliance journey, and every part of my experience of the customer is going to be determined by that. So when the regulation changes, they can't change. Whereas a fintech can work with a partner. Maybe it's companies like PPS in terms of e-money. It could be, an open banking partner who's regulated to do AISP or POSP type things. It could be an authorized lender. And because the fintechs have a partnership mentality, they can adapt. So, I mean, I think it's it's a kind of long answer there, but I don't think there's any issue at all for fintechs. It's a question of balance. It's not even a balance. For fintechs, they have all the tools to exploit and really go forward.
Can I add something there, Doug?
Please.
So I think one of the great things about fintechs is they are absolutely focused on the user experience. The product is king. And fintechs want the best product. They want a great reputation, typically with their customers. They want to keep it simple, transparent, because it's a highly competitive market, and they're taking on the incumbents. And I don't think that that's necessarily the perception that one has necessarily of the more traditional providers. And I think regulators felt that perhaps traditional providers weren't always focused sufficiently on the user experience, on the user, on the product, on prominence of pricing and so on. And so in a way, I think the fintechs, the non-bank financial institutions, of the e-money institutions, the payment institutions, were kind of pushing a bit at an open door, because they were already doing a lot of, let's keep it simple, let's make it attractive, let's make it work well for the customer. And a lot of that is aimed at, or has historically been aimed at, by regulation, trying to make sure that there are no hidden surprises, no unfair terms, no catches, that it's a product that works well for customers. So I think that perhaps some of the reason why regulated providers in the UK at least have had relatively light touch supervision has been because there's been a sort of similar direction taken by them and by regulators. Ray also touched on an important point, which is the banks with legacy systems. And I think it is true that banks have built up legacy systems over decades and decades, and it has probably at times been really difficult for them to adapt them in order to respond to either competitive pressures within the markets and the need to sort of quickly launch new types of product or upgrade products, but also to respond to regulation. It is tough. And I think strong customer authentication, again, has shown how difficult it's been for the industry to implement. And if there is perhaps one thing that one could ask more of from some regulators, particularly perhaps at the European level, is to be more aware of the challenges of technological implementation of new initiatives under regulation. Because it's not always been obvious that the legislators have understood how much effort it takes operationally to implement change, to redesign systems, to respond to new requirements such as open banking or strong customer authentication, or in other areas too.
Yeah, let me give you also an example. I think examples are always a great way to get this across. And if you look, like last year, maybe it was last year, when I think BA had a data breach. Yeah, so effectively cards that had been used on BA's website, were compromised, which is not the first time it's happened, won't be the last. It happens a lot, and it's happened for years. It was interesting that Monzo were the first company I ever saw who saw that there was a breach. They were able to go into their data warehouse and very quickly, I think within hours, identify all of their customer cards that have been used on the BA PSP sites. And then they communicated to all of their customers to say, we've seen your card has been used on this website. We're going to block your card and we're going to send you a new one. That is the sort of responsiveness. And that's what the regulator should be really lauding, the ability to respond. There's no way, retail banks couldn't have done that. They couldn't have done it because of their systems. And they probably, frankly, would have spent a week going through various kind of risk compliance committees before deciding whether they could even tell their customers it had happened. For Monzo, it was, no, this is the right thing to do. We've got the data, we'll do it. So those companies can push the regulation where it needs to go, which is protecting the customer and being transparent. So, I think they're in great shape.
This is incredible to hear. And maybe I've been incorrect in my previous perception of the traditional banks will always be completely compliant. They're used to the regulatory shifts, and it's maybe these upstart fintechs that are maybe laggards when it comes to compliance. But hearing this obsession with customer experience and how it actually leads to an incredible compliance suite is absolutely brilliant to hear. Now, we're used to, obviously, as well, with the large institutions being multinational and dealing with regulatory compliance in numerous different areas. Ben, I've got to ask then, with fintechs that may have just started out in, for instance, Old Street and are used to that UK market and the wealth of regulation that's come out from Europe, and that might be changing, do you think that some of the fintechs are going to face increased pressure on their operations side with all these now, potentially different regulatory zones? And can you tell our viewers about the temporary regimes that are in place to maybe mitigate some of the resulting operational headaches?
But of course, we're now two different jurisdictions, the EU and the UK. For now, the laws are still very, very heavily aligned. So I think that you've got, as a starting point, a pretty high level of confidence that if you've got an operating model, a product, a business structure, terms and conditions that work for one jurisdiction, they're likely to very largely work for the other. There can still be significant differences and local complications, but that frankly has always existed even when the UK was part of the EU. Of course, there can be and probably will be increasing divergence over time. And then I suppose it becomes for the fintechs a question of figuring out, well, what's my plan? I need to start somewhere, and then I need to figure out what market do I want to target? Where am I going to start doing business? Where do I need to get my license? And then typically they're looking at expansion, including international expansion over time. And so that might mean, well, okay, I'm going to perhaps have to get multiple operating companies, each with their own license to serve a different jurisdiction, whether it be the EU or UK or other jurisdictions beyond. I think the interesting choice for them is, where do they set up? Where do they start off? You said Old Street, and of course Old Street is in London, so it's in the UK. And one of the things that the UK, I think, is going to want to do, and I know this is not quite your question, but I think it's part of the mindset for fintechs. The UK is going to be thinking, well, we want to make sure that these businesses continue to set up in the UK, even if they're looking at bigger markets such as the EU, because we want them to do business in the UK, we want them to do business in the EU, we want them to have their global headquarter here in the UK. And to do that, you need to provide various incentives for people to set up in the UK, even if that's not going to be ultimately their primary market. And part of the incentive is going to be around regulation. So if you make it easier to set up your first operating company in the UK, knowing that you're going to have to do some adaptations for the EU, where it's just, and you're a fintech, so you're a startup, so you've not got a great deal of money, you have to be very thoughtful about how you invest. If the resourcing and other regulatory requirements for a startup are less demanding in the UK, you think, well, all right, I'll start in the UK, I'll build up my business, I'll get a bit of traction, I'll raise some more funding, I'll go to my Series A, B, C, and so on. That will give me a war chest to then pay to start expanding into the EU, perhaps next, and then wherever else I want to be. So I think that's part of the mindset. And, Ray touched on the fact that funding is so important. It's really interesting that the Khalifa Review is recommending funding and different ways of easing funding, making it easier ultimately to list, for instance, for a new fintech business in the UK. There's a big focus on that. Clearly, the government's being thoughtful there, but regulation also. And I think it would be interesting to see how we do have this divergence over time as the EU potentially goes towards much heavier regulation, perhaps. And in some ways, at least, the UK might go for lighter touch regulation. But I don't think we can necessarily take that for granted, because we know that the UK, the FCA, has a big focus on consumer protection. But they may, in some respects, arguably be more proportionate than some of the EU initiatives. They hopefully will be more cogent in terms of how they approach regulation, because there's just one country to please, just one country to regulate. I think in Europe, there's a lot of compromise that goes on. Ray touched, for instance, on the tightening up of money laundering regulation for fintechs, and that in part was driven by political pressures from certain countries within Europe, and arguably went too far or further than it needed to go in terms of imposing higher obligations around when to KYC customers and so on. So there are less stakeholders, I guess, in the UK, so possibly we can be a bit more nimble, a bit more accommodating, make life a bit easier, and hopefully therefore a more attractive environment for people to either keep their HQs here or to start up here and expand from here. And you were asking about the temporary permissions regime. Now, I mean, this is, there may well be some sort of temporary permission regimes in the EU, but on the whole, there is no sort of EU level temporary permissions regime. So typically, a UK company that is targeting the EU market will ordinarily have to get a licensed entity if it's a regulated payments or other product. We'll typically need to get a licensed entity in the EU. However, for now at least, the UK, perhaps more generously, it might be argued, has permitted that a lot of financial services providers, including payments firms, who are licensed in the EU and not licensed in the UK, have been permitted to continue targeting and offering their services to the UK market if they were passporting into the UK before Brexit, before the end of the year. And that temporary permissions regime had been intended to be for up to 3 years. But what we are seeing now is that a lot of EU payments and other firms are getting landing slots, so they're being asked to seek a UK license rather more quickly. At least they've been given some time to continue doing business in the UK before having to get a license. Various other initiatives in the UK as well, such as substituted compliance, and that is saying, look, the UK has implemented lots of EU laws. If you are complying with those EU laws in your home state, say Ireland or Netherlands or Belgium or Luxembourg or wherever it may be, you can continue to comply with your home state rules rather than having to comply with the UK onshored ones for a period. It has to be said though that right now there is some uncertainty about to what extent substituted compliance, this concept, is available for payments firms operating in the UK. The legislation is a little bit odd, so we'll wait to see whether that gets clarified. Hopefully that answers your question, Doug.
Yeah, in great detail. And before we go on to the further discrepancies within Europe, as we saw with some of the AML and KYC issues you mentioned, I think it'd be really interesting to, if we're still on the topic of regulatory changes and compliance, how the discrepancies we may have seen specifically within onboarding because of these KYC changes have affected businesses or fintechs or payment companies operating across all these regions and even ones within Europe. So Ray, could I get your input when it comes to the onboarding process and the regulatory discrepancies there?
So there are some different interpretations, and if you talk about onboarding, typically it's knowing your customer, knowing your business regulations, which is kind of underpins most of anti-money laundering regulations. But if you take a market like Germany, they have actually much stricter requirements on that knowing your customer process, the extent to which, until very recently, everything had to be face-to-face. You literally couldn't open up an account online without actually going into your branch. Now, fintechs have responded by lobbying for video KYC, and you'll see that's pretty common now. And it's another good example where, okay, the problem is this a real person? Can I check their passport? Now, actually, as we all know, when we used to travel, actually, AI is much better at telling who you are based on a passport than someone behind a desk in a bank. So why wouldn't that work online? So taking the technology and making a better KYC process by using video KYC is actually showing how you can move it forward. But as I say, specifically Germany has that very specific regulation, and I think we've spoken before that in a level playing field of, let's say, the EU, in theory, what's written is level playing field and regulation for passporting, etc., which we do from Brussels. However, local regulators have a kind of get out of jail free card, which is always down to they have the ability to step in with their own views around anti-money laundering. So whilst you can operate in these markets, the regulator can have its own hurdle rate in terms of what they expect you to do. And I think that's where the regulation has gone halfway to creating a level playing field. But when it comes to financial crime, and some of that will be historic, it could be cultural, there could be certain markets where financial crime is more of a problem, and therefore the regulator, quite rightly, and Ben alluded to AML, and specifically, in France, the requirements are much stricter, and that's actually, a lot of people would say that was a political reaction to the terror attacks, which were deemed to be in this, where some of the more innovative prepaid cards and things were used. It was never fully proven. So you're still going to come down to the domestic regulator, who will say, well, I don't have a problem with a German company coming to Italy or an Italian company coming to Finland. However, I'm still going to protect the crime impact of finance. And that's where the onboarding probably is the biggest impact. But Ben, maybe you got some better insight to that.
Yeah, I agree. I think the reality is that even within the EU and the passporting zone, if you like, and even though payments and e-money laws are meant to be ones that you pretty much comply with just your home state, your licensing state rules, in practice you can see, in one way or another, differences of requirements in local jurisdictions. And of course, money laundering has always been, and the onboarding process and the friction that goes with it has always been one that's been front of mind for fintechs. I mean, I would say, based on my understanding of the 4th and 5th money laundering directives, that generally the money laundering regime that applies ought to be the money laundering regime of your state of licensing, or the state from which you're operating, also known as the state of establishment. It oughtn't to be the host state where you're offering services cross-border rather than operating from, say, a local branch or other establishment. But Ray's quite right. You do nonetheless see that some jurisdictions appear not always to honour that and do effectively impose some of their own requirements. And there's also a practical operational difficulty, of course, which is that you may have something like video checks, but other people may rely on databases, which will process information and then see whether information given by a customer matches up to give sort of a positive confirmation of identity. And databases will vary in terms of richness from jurisdiction to jurisdiction. So you just may not find that you've got a database or other tool that is working across the EU, not just because of regulatory challenges and local regulatory obstacles, but also just practical challenges. You may find that the data you've got in the UK is great, and in certain other jurisdictions, we'll say in France or Germany is great, but in other jurisdictions not so good.
I think that's another good example I could give there is on banking specifically. So you've got general payment regulation and specific banking regulation. When you open up an account for a customer in France, there is a dedicated database that we have to submit information on that customer in a certain format just for French customers to a company in France that collects it, and then every transaction, etc. Now, if we're opening an account in Belgium, it's a different database with a different format, and it goes on and on and on. So there is still those domestic requirements. So it's still not truly transparent, and it will depend how full the service is. Some payment services can operate very ubiquitously across the EU, but other types of financial regulation, you're going to be dragged into domestic issues.
That's really interesting. After having that, almost the idea or the concept that the local regulators don't have much to play within SEPA. So with that in mind, then we've talked about the kind of payments issues within that, but I want to go into the practical issues for a lot of businesses that maybe operate as enablers in this ecosystem because they've embedded payments into their system at the very heart. Companies like Deliveroo or Uber. They operate worldwide while still keeping their payments central to their business. So Ray, how can these enablers keep up with the regulatory changes in payments now that they're so closely connected to offering a seamless payments experience?
I think the same way that fintechs adapt, and they understand. I mean, first of all of the big tech guys hire payment experts. Anyone with a payment expert looking for a well-paid job in tech, go and knock on these guys' doors. So they get the right expertise, and they can afford to buy in the right expertise. So the first thing they have a very good, clear understanding is what's the framework they start with. The second thing, why do companies like Uber and Deliveroo exist at all? Because they solve problems that other people couldn't see, problems with using, the domestic taxi service or a very disparate sort of takeaway experience. So they are trained, their DNA is solving problems. So when you put in front of these guys regulation that's written, and it's quite prescriptive, you can do this, you can't do that, blah, 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 they will solve those problems. And they'll do it pretty quickly. And the product culture that Ben alluded to means they're always going to think, as Ben said, first about the user experience. Secondly, operationally, how efficient can we make this? And they're also going to think about how economic they can make it, because they're not going to kill their business through regulation. And through that, they will adapt, and they can adapt. Examples, for example, strong customer authentication, which you would have thought where for an e-commerce transaction above €30, you have to make some form of third authentication of a customer. And many of the people watching will have got text messages when they're buying stuff. Now, you go on Amazon, you will not get that. And the reason you won't get that, well, first of all, they may have transactions below €30, but typically most merchants ignore that one, because even if it's a transaction less than €30, you have to count how many €30 transactions you've had with that customer before you get to 5, and that's too much hassle, so don't bother with that. But you've got risk exemptions. Therefore, if you can demonstrate that your level of fraud for a £100 transaction is less than something, then you don't need to do the strong customer authentication. And of course, the companies that I'm mentioning, and you've mentioned, they all share a love of data and a love of metrics and analysis. So they're very good at being able to, first of all, identify fraud trends. So therefore the fraud comes down, therefore they don't need to do the strong customer authentication. So I think the regulation, I keep coming back to it, I think a lot of it plays into the hands of the fintechs. And it's probably one of those unintended consequences of the EU, who initially probably still have a bit of an issue about the big tech guys, who typically are American, coming into Europe. But actually a lot of this regulation, it's going to be fine.
It is interesting how that kind of customer experiences we've alluded to in the previous part of the conversation is that driver. And Ben, sorry, did you want to jump in there briefly?
Yeah, I mean, I've got the I and my team have got the privilege of working with a lot of e-commerce platforms, and completely agree with what Ray said around their ability to adapt to regulation and to implement regulation. And it's important to remember, of course, that they are often incredibly well resourced, particularly if you're looking at big tech. I agree as well that they will tend to have very professional payments teams. And for them, payments is important because it's part of the relationship they have with, in particular, sellers, merchants on their e-commerce platforms. And they want to make sure that there's a good experience for those merchants all around. And payments is part of that. So they want to have this integrated solution. They want to manage the broad solution platform, marketplace payments. And they've got the resources to do it. They're not out typically to make money out of payments, of course. That is not the core part of their business. So they will use the resources, again, to focus on having a sort of integrated, minimal friction platform that they can provide to their customers, including the payments experience. And all of that resourcing, and the resourcing is not just financial, of course, but also the resourcing is in terms of developers, of coders, of engineers, whatever they may call them. They will have armies of them because they're tech businesses. They will have armies of them in a way that, you know, a fintech may not have as many. And so they are very nimble in terms of adapting their systems. And again, as Ray said, they're very strong on data, so they can, appropriately use data to help comply with regulation, whether it be the transaction risk analysis exemption from strong customer authentication or otherwise that Ray has mentioned. So it's about resourcing, it's about focus, and they tend to do a good job. They're very professional about it.
I think that's really interesting, and that there's two parts there that I really want to unpick. One, that kind of marketplace ecosystem model that these companies really do thrive in, being that connector between making payments invisible, but also offering up not just payments as a service. With that in mind, and because they have that, as you said, Ben, that army of engineers and that love of data, while also being central to the payments ecosystem. Ray, could I ask, does that give them an increased burden when it comes to liability, when it comes to the authentication, or at least looking at the security of a payment going through?
Well, no, I think it's, as I probably just said, the previous point, I think gives them advantage.
Yeah.
It gives them an advantage. You know, we've worked with companies like PayPal as a customer for 10 years, and one of the interesting things about PayPal when I first started working with them is I thought of them as a tech company, and that was it. You know, I thought, okay, they're a tech company. They're not. They are a payments business through and through, and the reason they were very successful was because of their management of risk. That was actually, if you spoke to anyone in PayPal, and if you do, management of risk is like the number one KPI, which is bizarre if you think about it. You'd assume that it was all about the reduced friction in the checkout, which clearly PayPal have had a huge, they've changed the whole world of e-commerce because of the way they did it. But it was because they managed risk. They were therefore able to lower their cost of fraud. They were able to pass that on to merchants. They were able to gain more market share and invest in being a better company. So, it is those kind of advantages. You go into payments, you cannot just look at one part of the framework. And PayPal have been very successful at that. And as Ben said, all of the big e-commerce, big tech players, the disruptors, the headlines, the unicorns, they will all share a view that security, management of customers' data is the number one thing. What I always think is that if you're a VC, a venture capital investing in some of these fintechs, what's the black swan that's going to kill your business? And actually, We saw one last year in Wirecard, although it wasn't exactly to do with regulation, but these companies have come into the market very quickly in many cases, and their valuations are in many cases based on the future growth of these companies. Now, if due to a regulatory breach they're out of business or their reputation is damaged, then that valuation is going to come down pretty quickly. So actually it all serves the security risk compliance for all fintech companies should be the number one topic on a board meeting or a business plan.
Interesting. So then, Ben, I want to throw the question to you then about mitigating risk. Do you think that these fintech firms, these exciting tech companies, do you agree with Ray there that it is effectively, it's a cultural thing as well as having the data, but mainly it's a cultural thing and keeping that risk at a minimum right from the off?
Well, I would never dare disagree with Ray, but I can add a few thoughts around this. I think it depends as well where you are on the journey. So Ray has got oodles of experience. You're talking nearly 2 decades of experience of running a business in the sector.
You're making me sound old.
But it's important, and PPS is very mature. I think if you're in a startup fast growth phase, then the reality is you're probably not going to yet have the resources or experience to be absolutely fully compliant. And you will find that there is a little bit of a balancing act that you may see within a startup of trying to drive forward the business and be thoughtful about how you go about meeting all of the compliance requirements within your limited resourcing. And so there have been, stories in the press, of course, of different companies which are in early phases that even where they're fast growth and getting lots of traction, may sometimes get criticized for not having been as compliant as they can be. Interesting also that nonetheless in the UK, at least, the FCA has tended to try to work with those firms to improve their compliance rather than come down on them like a ton of bricks. Safeguarding is a great example, by the way, of where it's always been very challenging for fintechs to be absolutely compliant. Just as frankly it's incredibly challenging for any firm, perhaps impossible, to be completely compliant, because there are going to be areas where it may be open to interpretation what you have to do and what you shouldn't do, or there could be other good reasons why it may be difficult to be absolutely compliant. So I think there's a little bit of a grey scale. I think though that Ray's absolutely right. When we see investors going in, for instance, who are going to do something like a Series A, at least from that point, they are expecting to see a fairly well-oiled compliance and governance machine within a firm. Because if they're putting in some serious money, they want to make sure that the firm's not going to have big damage to its reputation or have a business model that doesn't work because it's non-compliant.
With that in mind, then, this is part of a larger series, and we are going to be talking about those enablers and how important they are to the payments ecosystem in the future. So, Ben, thank you very much for that input. But before we move on to the next subject of enablers in the next topic, Ray, I want to come and talk to you about the smaller firms and something that seems to be increasingly happening in the world of payments, and that's IBAN discrimination due to geographical location. Now, why is this happening, even within the EU itself? Because isn't it illegal under SEPA?
Well, it is. Yeah, it is illegal under the regulations to what they call discriminate, and effectively, it's an experience where an IBAN is unique to a country in terms of its prefix, even if it's all in euros and you can transfer money from one country to the other. That's the whole point of SEPA. But if you're regulated in France, it's a French IBAN. If you're regulated in Belgium, it's a Belgian IBAN, etc. If you're regulated in the UK, you can have a GB IBAN. And we've got all three of those. and we've got a few more countries coming in the next quarter. The experience of the user is, though, they may go to their power company or cable company in a particular market, and when they come to set up a direct debit, if they don't put in the prefix of their country, then the payment may not be honoured. It might not even be allowed to be accepted because there might be an algorithm that stops it. And then in certain, certainly if you're paying tax, for example, in France, especially if you're a company, you cannot pay your tax from a bank account that doesn't have a French FR IBAN, even if it's an account in Europe. So that's what it is, and it's a real thing. I think it's going to become a bigger issue as separate instant payments becomes, because instant payments will become the way people check out, and if they can't check out from a merchant for some reason, it's going to become more critical. I think the reason why has it happened is because on the one hand, you've got a concept which is sort of borderless bank payments, which is great. It's exactly what the EU is there for, to reduce friction, lower the cost of doing business, and allow for citizens of the EU to work and move their bank accounts wherever they want to. That's the principle. The reality is, and maybe it's a question of time, you've still got domestic banking systems that are connected to each other, and you come back to this point that you've got domestic banks who still consider the country they're regulating as the most important thing, and therefore, like the anti-money laundering bit that we mentioned earlier on, they are going to take a slightly more localized view. You've also got a risk perspective. A merchant may a utility company may quite rightly say, well, why is someone with an Italian IBAN trying to set up a direct debit to pay for an electricity bill in Ireland? So there's probably that piece as well. But it's just an example of where the right kind of view of the regulation is getting forced onto a kind of domestic sort of foundation, and it doesn't work. Now, and I guess it doesn't work because, passporting is not something that is done a lot historically in payments. It's the e-money institutions, the payment institutions who've driven a lot of that. And therefore, the idea that one company is opening up accounts in different countries with different IBANs, that's kind of a bit unusual. Most banks in Europe are regulated in the countries they're in. And so it's more, again, it's the enablers coming in have said, why not have, a bank account, even if you live in a different country that's in euros? And the regulation hasn't really moved forward with it. What we're doing at PPS is, as I say, we've established branches which is what you have to do. You have to establish a branch in a country. Therefore, you are allowed to get your local IBAN, which we have in France, Belgium. We're launching Italy and Spain and Finland this year as well. That doesn't come without a cost, though, as I mentioned earlier on. Then you've got the burden of having to provide certain information to the French regulator or the Italian regulator or the Finnish regulator. So it solves a problem for the business, but it comes with a cost. But again, we adapt, and we work with fintechs. I like to think of ourselves as probably in that ballpark. So we try and solve the problem, we adapt to it. So yeah, that's a good example.
Definitely, and I think that really hits the nail on the head when it comes to fintech is solving a specific issue that a lot of people don't want to be dealing with themselves, and moving that on so people can focus on their core business. So guys, I think that's all we have time for. Thank you so much for your expertise in this area, because as I mentioned, this is going to be a series where we do look at the broader sense of payments, and I think regulatory issues and compliance is so important at getting that groundwork. So thank you very much. And to all our viewers, thank you as well. You can watch the rest of the series and much more over at www.fintechf.com, and of course YouTube and LinkedIn. So thanks very much, guys, and I'll see you soon. Goodbye.